Welcome, ladies and gentlemen. It's a great pleasure for us to present our new gold report. My name is Mark Wallach, and this is my dear colleague, Ronald Stöfferle.
Good morning, ladies and gentlemen, hopefully all over the world. We're very proud to present you now in a new format, in an online format, of course, due to the COVID crisis, our 14th annual In Gold We Trust report. The leitmotif, the title of this year's report is The Dawning of a Golden Decade. And we said at the beginning of this new decade, we want to present you the long-term view. What's really the big picture for gold for this decade? What are the most important drivers, the most important catalysts for gold, for the mining space, for our macro picture regarding inflation and deflation? And we will present you the highlights of this year's In Gold We Trust report in the upcoming 30 minutes. But before, I would like to thank our premium partners. As you know, this In Gold We Trust report is probably the most widely followed publication on gold. Last year we had roughly 2 million readers. It is available in German and in English in an extended and a compact version. And starting last year, we also have a Chinese edition of the report. And it wouldn't be possible to present this or to do this report and to publish it totally for free without the support of our premium partners. It's, I think, the creme de la creme of the gold business, and therefore we are very, very thankful for their support. This report wouldn't be possible without the support of our fantastic team. As you might know, this report is nowadays really the gold standard, like the Wall Street Journal once said, of the gold industry. And we've got 20 people working very, very hard to publish the report, to edit everything, to write and to proofread it, to translate it, to crunch the numbers, to do all the charts. And so a big thank you to the whole team of our In Gold We Trust report. Let's have a look at the key takeaways of this year's report. Ladies and gentlemen, if you saw or if you read last year's report, you probably can tell that our calls were pretty much spot on. Last year we said that we're in a new bull market, but that we're in a new bull market that most people don't really recognize yet. So the conclusion of last year's report was once we go above this resistance zone at 1360 to 1380, the new phase, the so-called public participation phase of this bull market will kick in. Only a couple of days after we published the 2019 report, actually we went above this resistance zone. I think it wasn't primarily just due to our report, but perhaps we helped a bit. And it is pretty obvious to us that we are now in a bull market, basically in every currency, in a bull market that will last probably for many more years. Now, what are the main takeaways of the report? First of all, monetary policy normalization has failed. The coronavirus is only the accelerant of a recession that was overdue anyways. Deflationary forces are very strong at the moment, but going forward we see inflationary risks on the horizon. The debt-bearing capacity is reaching its limits. Central banks are in a quandary when it comes to combating future inflation. We are, ladies and gentlemen, in the zero interest trap. We're seeing the dawn of a new monetary world order, new gold all-time highs, also in US dollar terms, are only a matter of time. Ladies and gentlemen, we should not forget that gold is making new all-time highs basically in every currency, but in US dollar terms. We have seen many all-time highs on a euro basis. We've seen it in every currency, also in strong currencies like the Swiss franc, for example. But the only currency, the last man standing on the currency front is basically the US dollar. And from our point of view, we will see new all-time highs in US dollar terms very soon. And our valuation model shows us a price target of 4,800 US dollars by the end of this decade. And this 4,800 might sound quite bullish, but actually the calibration is quite conservative. And my colleague Mark will talk about this model a bit later on.
Thanks, Ronnie. Let's have a look at the performances. What did gold do? How did it perform recently? And we like to start with this yearly overview in various currencies, in major fiat currencies. And what we see there is that we, as Ronnie mentioned, saw very strong performance basically all over the board. So that's in euro, US dollar, pound, Aussie dollar, Canadian dollar, Chinese yuan, Japanese yen, Swiss franc, and Indian rupees, all green, basically also 2019 and year-to-date 2020. What is still notable is that the performance in dollars is a little bit lagging relative to the performance within the other currencies. That's due to the relative strengths of the dollar, but still, also in dollars, we have already seen the bull market continue its pace. Very importantly to say that basically in all fiat currencies except the dollars, we saw new all-time highs recently or are currently at all-time highs. Last all-time highs were generally in 2011, so it took the market 8 to 9 years to regain basically these all-time highs, and we have exceeded these all-time highs by now. So this is just as an example, the gold performance in US dollar and in euros. And as I just mentioned, the all-time high 2011, we already exceeded in euros and various other fiat currencies. We have not exceeded it yet in US dollars. In our view, it's a matter of time, basically, but the momentum clearly is visible. This is a new bull market, and actually on this graph, one can see that the bottom of the gold price in euro already was earlier than the bottom in the gold price in US dollars, and that's also a general trend. So we've been pointing this out, that gold priced basically in the world currencies is already in a bull market since 2014, 2015, and only since 2016 gold has been a bull market in US dollars. This is even a longer chart which basically shows the long-term decline in purchasing power of fiat currencies measured in gold. So it's important to note that fiat currencies are basically designed to continuously lose purchasing power, and they do this by the increase of money supply, and obviously the stock of gold is very constant, so gold is a very good long-term inflation hedge, and this is very visible in this chart, which shows that the purchasing power of fiat currencies decline, and again, this works for all fiat currencies. So now let's have a look on this chart. So what we see here, this is basically very important monetary policy data of the Federal Reserve for the United States. And what we see is, first of all, the balance sheet. So the Fed balance sheet is in blue, and we see also federal funds rates. And what usually happens is when a recession starts or close to the beginning of the recession, the monetary policy is lowered. And what we want to point out here, and we pointed it out last year already, obviously now everybody is talking about the coronavirus, and we will do that too, but just looking back to 2019, it's important to point out that actually 2019 was the year where the economic activity already declined significantly. There are various indicators which point to that. First of all, one could point to yield curve inversions, which is a very reliable indicator for upcoming recession. Also, like real-world data of world trade. So world trade declined in 2019 at about 0.5%. This is a very unusual occurrence. It only happened twice since 1980. And in both of these two instances, we were going to recession. So in 1982 and 2009, that was the last time. That happened 2019 also. And very importantly, the Federal Reserve started to go on an expansionary monetary policy again. How did they do that? Two things. Basically, they started with yield cuts, so interest rate cuts, and they reversed the balance sheet policies in autumn. So the balance sheet was expanded again. Actually, we were on this normalization path, and that was communicated that this was going to supposedly happen for a long term, but they had to reverse in 2019 before the corona crisis hit. And this is, as we are expanding in the report very in detail, very important fact, because this means that structurally the economy was not healthy, and this is also going to have severe consequences how and for the time after the coronavirus. So this is one thing to remember. What did gold do during all these times? So, as we have been pointing out very reluctantly, gold is a very effective portfolio diversifier. So, what we can see here is the equity performance and the gold performance of various countries. So, what happened obviously this year, especially in the first quarter, we saw steep equity declines, stock market declines, and we saw a rise in the value of gold. So basically gold did a perfect job in hedging the portfolio and diversifying the portfolios. So this is something to keep in mind. Gold as a portfolio diversifier does make sense, and that's something which we are also emphasizing in our reports regularly. So during this process, gold has started to be rediscovered by, for instance, portfolio managers. It's our view that one marginal buyer of gold is basically the financial industry, which has been, in many parts of the world at least, neglecting gold severely. So gold allocations towards portfolios are typically very, very low. And one way how to see this is looking at ETFs. So this is exchange-traded funds which are holding gold and which are a trading vehicle for portfolio managers usually. And what we can see is during the bull market up to 2011, obviously these ETF holdings were increasing, but were reduced when confidence came back into the system 2012, 2013, and the gold price fell. But since 2016, these ETF holdings are increasing significantly. What is also notable here, these increases are coming mainly from Europe and mainly from North America. So portfolio managers in the Western world, let's say it like that, are increasing their gold allocations via ETFs. Altogether, these ETFs have 2,800 tons of gold, and in the year 2019, 400 tons were this amount increased by 400 tons. So this is quite notably happening. If one compares these ETFs to the market capitalization of equities, one sees a relative increase already, but it's still way below its high. So still from a portfolio allocation, portfolio managers aren't too bullish and have not loaded up too much gold, it seems like it. So this is also something which we go through into more detail in the report.
Now let's move over to the central banks. Ladies and gentlemen, from our point of view, what's really most notable for this crisis compared to 2008 and 2009 is, first of all, that central banks acted much more quickly and they acted much more aggressively. And the third point is that this time around, it's not only central bank policy, so it's not only monetary stimulus, it is also fiscal stimulus that was implemented very, very quickly and very aggressively. Just to give you a thought about the numbers that were basically injected into the system since the whole corona crisis hit, the total amount of fiscal and monetary stimulus as of mid-May is 20.2 trillion US dollars. So that's fiscal and monetary stimulus that was injected into the system since then. To put it into perspective, that's 23.6% of world GDP, or twice the total market capitalization of gold, of all the 190,000 tons of gold that were mined throughout history, or 124 times the annual gold production. So those numbers are big. They will get much, much bigger. Expect more monetary stimulus, expect much more fiscal stimulus. And as you can see here on the chart, those liquidity injections by the central banks are almost off the charts. So on a year-on-year basis, the growth rates of monetary aggregates are at the moment between 25 and 30%. As you can see, it is not only the Federal Reserve, which is very aggressive. Of course, it's also the ECB and it's the Bank of Japan. And as you can see here, those growth rates are basically unseen. The central banks try to basically balance out the deflationary pressure that we're seeing. They're trying to compensate for this deflationary pressure that is coming out of the banking system. But that also means that over the longer term, the inflationary pressures from our point of view are growing significantly. And as you can see on this very long-term chart, actually stocks are underperforming gold again. So the so-called Dow Gold ratio is already going lower since the fourth quarter of 2018. And from our point of view, this is a very, very important signal. It is signaling that there is a tidal change happening. We're seeing that gold is picking up relative strength against equities, but also against bonds. So the market breadth of this move in gold is very strong. Gold is rising in every currency, gold is rising against stocks, and gold is rising against bonds. Now the debt situation, I'm sure that you have all read quite a lot about those staggering amounts. Here again, a very long-term chart. The federal debt as a percent of GDP for the USA since the year 1790. And you can see that we're basically at the highest level. We're hitting an all-time high, and of course we've never been higher in peace times. So the CBO, the Congressional Budget Office, was already announcing a deficit in the US of 4.7% last year. And for this year, we don't know how high it's going to be. Recent estimates are around 14%. But of course, it's also an election year in the US. So probably it's going to be even higher. So we're analyzing quite in detail in our this year's report. First of all, the debt developments when it comes to governments, but also when it comes to private households, the corporate sector, where we already showed last year that in the triple B sector in the USA, there are already problems arising, and those problems were basically they showed up quite significantly in the last couple of weeks, and this is the main reason why the Federal Reserve is now basically intervening in the corporate debt sector as well. Now, ladies and gentlemen, when I did my very first press conference about gold, I remember gold was trading around I think $650 or 500 euros back in 2007. And back then people always said, yeah, but gold doesn't pay any interest. So that was the main argument that people made against gold. And I said, yes, it doesn't pay any interest. But nowadays, gold is, one could say, even positive yielding, especially versus most of the government debt. What you can see here is the global negative yielding debt market value, and at the moment it's more than 14 trillion, so 14,000 billion US dollars. That's roughly the combined GDP of Japan, Germany, India and the UK. So those are big numbers. And you can also see that there's a very high correlation between those negative yielding bonds and the price of gold. So the more negative yielding debt, the better for the price of gold. Now, the big question for us is, ladies and gentlemen, once we see that inflation becomes a concern again, where will this money flow to, those 14 trillion US dollars? As you might know, holding negative yielding debt in an environment of rising inflation is not the best idea. So therefore, we think that there will be significant amount of interest coming into the gold market once inflation becomes a real concern in financial markets. The central banks are another very important driver. Last year we saw almost a record high demand coming from central banks. It was only slightly lower than in 2018, which was the record year, the highest amount of purchases since the year 1971. And you can see that countries like Turkey, Russia, but also Poland, and of course China and Kazakhstan and so on, they are constantly buying gold. They try to diversify out of the US dollar. They try to hedge against a weak US dollar. They try to diversify their portfolios. And this year again, we've got a brilliant chapter on the so-called de-dollarization, so the long-term view on the US dollar as the world's leading currency. What's changing? We've got a great interview with analyst Luke Gromen, which reads like a thriller. Basically, it's really exciting. What's going on a macro level in the international currency system. And from our point of view, those purchases by Turkey, Russia, Poland and so on are a clear sign that the world is diversifying out of the US dollar. And you might know, ladies and gentlemen, that the commodity space is extremely undervalued. We wrote in the report that actually the last couple of months were unsuccessful in the commodity space, like the last comeback of Justin Bieber. So it wasn't the best environment for the commodity space. But of course, commodities are kind of the flip side of the US dollar. So if you expect a strong US dollar, commodities probably won't do so well in this environment. But as we point out in the report, it's always first the gold market moving, then it's silver, and then with a certain time lag, it is the commodity space that starts moving. And if you expect that the fiscal stimulus that is implemented and that will be used for infrastructure measures, if you think that this will really be a big topic coming from politicians going forward, then I think, ladies and gentlemen, that we should see a strong bid for commodities, for copper, for zinc, for iron ore, etc. And if you have a look at the long-term valuation of commodities versus the stock market, you can see that we're at the lowest levels since the year 1960s. So commodities are extremely undervalued. It's probably the most contrarian investment that you can make at the moment. Silver, very similar. In March, we saw the highest gold-silver ratio ever. Never ever in history was silver that cheap compared to gold. This year, in this year's report, we've got a special chapter on silver, roughly 30 pages, which is analyzing the supply-demand picture, which is very exciting. But just from a relative point of view, you can see on this chart that this ratio of gold versus silver is at an extreme. The last couple of weeks, actually, this ratio kind of reversed. So silver is picking up relative strength against gold, which is a very, very good sign from our point of view. And this year again, we've got a very long chapter on the mining space again. You might remember last year we have already been very positive on the gold mining space. We said that over the bear market that we saw, lots of creative destruction happened. So the companies were cleaning up their balance sheets, they were reducing costs, they sold off projects, and they really did their homeworks. And we said last year that we've never seen higher leverage on rising gold prices in the mining space. Now, 1 year later, we can see mining stocks developed pretty well. And it is not only this creative destruction that happened in the last couple of years, it is also the currency side. So local currencies are extremely weak versus the US dollar, which is an extra push for the earnings of the mining companies. And we are seeing that energy costs are coming down significantly. And energy is one of the most important drivers on the cost side. So this is a little bit of an extra. And we can see that generalists are coming into the market again. We see that huge volumes were traded in the large mining stocks like Barrick Gold, like Newmont Mining, but also in Franco-Nevada. We can see that generalists are coming into the market because there is earnings visibility. Just to give you one number, the Wall Street Journal said that in the last couple of weeks, as many companies for the S&P 500 lowered or completely cancelled their dividend payments like in the last 10 years altogether. So dividend yields might sound high at the moment on paper, but most companies are reducing or cancelling their dividend payments. On the other hand, mining companies like, for example, Newmont Mining, but also Barrick, B2Gold, etc., they are increasing their dividend payments. So from a fundamental point of view, there's a very strong case to be made for the mining space. And you can also see on this chart here, the party has only begun. So from our point of view, we basically just saw from the lows, from the worst bear market in history, the mining space basically doubled. At the moment, the HUY, the Gold Bucks Index, has a market cap of roughly 180 billion US dollars, which is only slightly higher than Tesla, for example. So from our point of view, mining stocks are very, very appealing at the moment. Now I would like to hand over to Mark to explain you our gold price model.
Thanks, Ronnie. Yeah, we have been looking at the gold price obviously very carefully, and we've been trying to figure out where the gold price was would potentially go. Just a very short note, looking backwards, we were, we actually, during the last 3.5 years, formulated a few scenarios which were based on the monetary policy of the US, and our main scenario was that the normalization of the monetary policy would fail within 4 years, within this period of presidency in the US. And for this scenario, we actually defined a gold price target of $1,800 or higher, being at January 2021. So this looks pretty realistic to us from the point being. We will see in January 2021 if this scenario basically will pan out as we thought. But now, looking forward, we again, since we are focusing this year on the big picture, since we are focusing on this decade, we decided to have a look even longer. So we looked at this decade, how could the gold price develop within 10 years. And to get a grip on this, we took basically two main input factors, one being monetary supply. So we've been looking at the US because in our view, the US dollar still is very important, obviously, for modeling and pricing the gold. And also since gold still, and rightly so, we believe, is perceived as kind of the antidote to the US dollar, the figures for the US are very relevant. So what we looked at is the development of a broad money supply, M2. And if we go back to the year 1970s and look at each decade and see the monetary growth, the growth of this money supply, we see different regimes. So we saw quite an inflationary regimes in the years, in the 70s, and we saw way less inflationary regimes in the 90s and 2000s. So we see basically the most inflationary regimes in the 70s, the least in the 90s, and a scenario in the middle is the 2000s. So based on these three historic precedents of monetary supplies, we basically again take these, extrapolate these three scenarios for the 2020s and weight these different scenarios. And I have to emphasize, we've been extremely conservative, in our view at least, when it comes to the scenario, the inflationary scenario. Given the whole circumstances, the debt situation and so on, I think one can make the case that the inflationary scenario is pretty likely. Still, we only gave the inflationary scenario here prudently a 10% probability. Bulk of the probability is in the medium scenario, and a small probability is also in the very conservative scenario of money supply growth. And based on the so-called gold coverage ratio, which is basically how much gold does the US have, and if it's basically marked to market, what coverage ratios of these monetary supplies does one get. And one sees, again, looking back the last 5 decades, that this coverage ratio oscillates. So at times, when gold price rises faster than the money supply, we get a higher coverage ratio. And if gold price falls or rises lower than the increase of the money supply, we get a lower coverage ratio. But in the long term, and that's also the reason why gold is a good inflation hedge, in the long term, the gold price basically rises with the money supply increase. So based on the coverage ratio and based on the different M2 growth scenarios, we approximated the gold price and basically a distribution with different probabilities, but the probability weighted peak in our view is $4,800 at the end of this decade. please note that this distribution is skewed to the right. That means the probability of a higher gold price is actually more likely than the probability of a lower gold price, given with these valuation parameters. We go into detail, obviously, on this model in the report as well, but 4,800, that's our probability-weighted peak for the end of the decade, priced in US dollars. So again, coming to the conclusion, or repeating the main conclusions of the report, before we open up to the questions. One, monetary policy normalization has failed. So that's, I think, important to note. There is no normalization of the US and also global monetary policy right now. The coronavirus is the accelerant of the overdue recession. Deflationary forces are currently extremely strong. Central banks, debt-bearing capacity is reaching its limits. Importantly, central banks are in a quandary when it comes to combating future inflation. And the dawn of a new monetary world order could occur within this decade. New gold all-time highs are only a matter of time. So that's basically the main conclusions to our report. Our model I just mentioned, 4,800, that's basically what we expect is quite realistic to see in a gold price in 10 years. With this, I think we would like to open up to questions if there are any. We have a moderator who will hopefully ask us these questions.
We have received 3 questions. I will post them together, and then I would ask you to answer them. What would be the price of gold by 2030 if your gold price model is calibrated less conservatively? The second question is regarding the battle between inflationary and deflationary forces. When do you expect inflationary forces to take the upper hand? And the third question is a short comment on the recent stock market rally. How do you explain it, given that the Federal Reserve of New York's nowcasting report calculates a drop of the GDP of 30% and more now for the 3rd week in a row, which seem not to get together with the recent rise in the stock markets?
Do you want to start with the model?
Yeah, I'll start with the model. Thanks for these questions. So if we only take, for instance, this inflationary scenario, the model would suggest that we have a gold price of 8,900 at the end of this decade. So as I said, we only gave this scenario a very low probability, but that's what the model would say in that case. The inflation versus deflation question I'll also take, if I may. This is a very interesting but also difficult question. So this is discussed very fiercely and argued very extensively in the financial community. Will it be deflation? Will it be inflation? Or how long will this deflation persist? I think this is probably answered best in a short version. Obviously, the question is velocity of money. When will basically the economy pick up? And if the economy picks up and this excess liquidity is not withdrawn fast enough, then basically these inflationary tendencies already could be shown. So this could happen within a matter of, I'd say, 6 months to within 18 months. That's, I think, some kind of a time horizon which we would say is realistic.
If I may add on the inflation versus deflation question, I think first of all it is important to say that during the last cycle we already saw massive asset price inflation. So there was monetary inflation, there was asset price inflation, And the third stage would be price inflation, what actually central bankers want to achieve. Now in the report we write at length about Murray Rothbard's level notes on the dynamics of inflation, for example, and we think that we might be on the verge of going into this third stage of the inflationary cycle, which is the way up to the so-called cracker boom, when people perhaps lose confidence in the purchasing power of fiat currencies. That's one thing. So we have already seen massive asset price inflation that shouldn't be forgotten. And from our point of view, at some point, rising price inflation might really become a concern. Now, what are the more short-term triggers? I think we should not forget that due to the whole COVID crisis, we're also seeing a strong tendency in the direction of less globalization, producing more at home localization. That, of course, is an inflationary driver. We are writing at length about ESG in the report. ESG is a very, very big topic in the mining space, but obviously, if you cannot produce your copper, your iron ore, etc., if you cannot open up new mines, at some point there will be an effect on the supply and at some point also on prices. A third thing that we see, which is really important, we're quoting a fantastic study, how people anchor their price expectations or their inflation expectations. And this study comes to the conclusion that actually grocery shopping, so supermarket shopping, is extremely important for anchoring inflation expectations. And from our point of view, we have seen that to some degree we saw rising prices in grocery shopping. For the US, for example, we saw the strongest rise in, I think, supermarket prices in 40 years. So this will have an effect on inflation expectations going forward. And then I think most importantly is one driver which we explain at length. It is this combination of central bank policy and fiscal policy. So we should not forget that things like MMT, modern monetary theory, or helicopter money that perhaps last year when we wrote the report and already explained the theory behind modern monetary theory, but last year it was basically for economists sitting in their ivory tower. But now, this time around, this is basically common sense that those extreme measures will be implemented at some point. And we don't know how it's going to end up, but from our point of view, be it helicopter money, be it MMT or QE for the people, whatever you want to call it, it will have a stronger inflationary impact. And then I think we shouldn't forget that due to the debt situations, we all don't know if it's going to be 20 percentage point higher or slightly less, but the debt situation, of course, is accelerating. And therefore, we can say, okay, the higher the debt situation, the higher the need for higher inflation rates, and the higher the fear of deflation. So from our point of view, this makes a perfect case for gold. And yeah, what was the third question? The third question was stock market. I think we would be liars if we would have said, okay, we would forecast the biggest drop in US stock market since the year, I think probably the Great Depression, and then such a sharp reversal that this would be happening. But we said in our note to our clients already that those measures that were taken by the central banks were extremely aggressive and that they would have an impact, of course, on the stock market. Now, I think this gap between the real economy and the financial markets is wider than ever. The S&P is above 3,000 again. And from our point of view, perhaps this was just a big dead cat bounce, so a reversal from really, really oversold levels. We wouldn't have expected such a dramatic move, but we also say in the report that normally within a panic, there's 3 stages. First of all, the initial panic phase, then there is the so-called dead cat bounce, and the third stage is when markets test the lows again on the most negative news. And we shouldn't forget, so far we haven't seen any really big bankruptcies. We saw some smaller ones, but those bankruptcies will happen in the next couple of months, and then I think we will really see if the S&P can hold those high levels.
We have received another question. With US, Europe, China, Japan all printing, will paper currency in general cave in and make way for gold? Or will some currencies, countries, say China, collapse in various degrees? How will the second scenario play out if it does?
Well, quite a complex question. Paper currencies are caving into gold, I would say, already to some extent. Perhaps not in the official monetary system, but definitely in portfolios of wealthy people, or also of individuals who are concerned. It's very important to note that it's on an international basis. One has the perception of gold is very different. So it depends in which culture one looks to, but I'd say continental Europe is quite friendly towards gold. Obviously, Asia and these regions are very friendly, and they are going into gold. The Anglo-American sphere is typically not so friendly towards gold. They haven't experienced hyperinflation for a very long time. I guess there is some causality, so they are a little bit the marginal bias, but generally speaking, gold is already perceived as at least as more and more interesting store of value. When it comes to the collapse of for instance, China, as was asked here, well, obviously that could happen. I mean, we especially if we look at in a time horizon of 1 decade, a lot of things are possible. I think it's worthy to note that all the different big economies have their problems. It's not specifically only China, it's the US, it's obviously the Eurozone, which has extreme problems. So we will have to be vigilant for big things also potentially happening in this decades in all regions. So, and especially if these problems become systemic, then that's our conclusion. The chances are that gold potentially really regains a part of the official monetary system, and at least will be included to some extent, perhaps as a SDR form, or also if things get really bad, local central banks could think and consider giving gold some more important role, but that obviously depends on what will happen this decade. But definitely, yes, prepare for such scenarios. That's definitely not off the charts.
Okay, I think, ladies and gentlemen, we are coming to an end. We would like to thank you sincerely for taking the time. You can download the report on our webpage, ingoldwetrust.report. You can download the report totally for free in German and in English in a compact version, which is still 100 pages. So you might know that we enjoy writing about gold, but I think this compact version really gives you the overview. But if you want to take some time and dig into the topic a bit more, I think we've got a fascinating extended version, again, more than 350 pages, discussing various topics of the gold industry. We've got interviews with Luke Gromen and with Terry Heymann from the World Gold Council. We've got some fun facts, for example, our traditional gold Oktoberfest ratio, but this time around also something for the football fans. Yeah, I think we should again sincerely thank our premium partners for their support, and our whole team for this year's In Gold We Trust report. Thank you very much for taking the time, and we hope that you will enjoy reading and studying the report as much as we did writing the report. Thank you very much.
Thank you.